Hey everyone, welcome to JAIIBontips. Today we will learn the chapter number 2 of AFM, that is Basic Accountancy Procedures. So let's start our chapter. So let's start with accountancy. What is accountancy? Accountancy refers to a systematic knowledge of accounting. Right? Imagine accounting as the organized record keeper for a business money stuff. When a business gets or spends money, accounting steps in and writes it all down. You have already listened about journal, ledger, right? But it's not about writing. It's like a detective that looks closely at the money story and then shares it with important folks like regulators and tax people or shareholders, anyone. So accounting is like the storyteller of a business money adventures. It writes, figures things out and tells a tale to the right people. Okay, so what are the accounting principles? They have been defined as the body of doctrines commonly associated with the theory and procedures of accounting, serving as an explanation of current practices and as guide for the selection of conventions or procedures where alternatives exist. It means that they are like the important rules for companies when they share money info. Imagine if everyone used different words and ways to talk about money. That will be confusing, right? These principal steps in and make sure everyone uses the same language and methods. So think of accounting principle as the peacekeepers of money talk. They make sure everyone follows the same rules, which helps us understand financial info better. Let's understand what is accounting concepts. Accounting concepts primarily refers to basic rules, assumptions and principles to be followed while recording business transactions and maintaining books of accounts. Accounting concepts are like scientific rules that are time-tested and applicable universally across the boundaries and different situations. It means that they are the basic rules, assumptions and conditions that define the parameters and constraints within which accounting operates. In other words, accounting concepts are generally accepted accounting principles, which form the fundamental basis of consistently preparing the universal form of financial statement. So they are the fundamental principles. Which have to be followed while preparing financial statements, right? Think of these concepts as a special set of rules that help accountants record money things in a smart way. They are like time-tested rules that work everywhere, like a magic key that fits an e-lock. Just like how scientists follow certain rules to get the same results, accountants use these concepts to make sure everyone understands money info the same way. So let's understand all the accounting concepts one by one. So what is cost concept? Every business transaction is recorded in the books of accounts at cost price. Irrespective of the market price, all the monetary transactions are recorded at the historical cost. For example, the machinery is recorded in the books by that amount which is paid to the supplier, plus the expenses of bringing and installing the machinery which are necessary to put it in working order. So what will be the cost of the machinery? The cost of the machinery is the cost of machine at the time of purchase plus the installation charges. Right. So let's explore the cost concept in accounting with a real life example. Imagine you are starting a small bakery. You buy an oven for rupees 10,000 and a mixer for rupees 5,000. Oven for rupees 10,000 and mixer for 5,000. Right? To make your pastries and cakes, even if the oven become more expensive later, like 12,000 rupees, the cost concept says you still record it as 10,000 rupees. Okay. It's like keeping a special money journal where you write down what you actually paid for things. This cost idea helps your bakery keep track of its valuable stuff called assets like your oven and mixer. Even if the assets become worth more over time, the cost concept says you stick to what you paid. This keeps your bakery's money story clear and fair. So what are the applications of cost concept? First one is fixed assets are kept at the cost of purchases and not their market value. Every transaction is recorded within the present value and not any future value. Unrealized gains are ignored. That means the gains which are not realized yet, which are not got yet, that will be ignored. An item that has no cost is not taken in books. I hope this is easy now. Fixed assets are kept at the cost of purchases and not their market value. That is easy. I told you before. Okay. So we have completed the cost concept. Next one is money measurement concept. Every transaction that is recorded in books of accounts must be measured in terms of money. All the transactions are converted into a common form, which is money. Example, quarterly production, sales, wages, etc. all are converted in terms of money. It simply says that a company should only write down stuff in its book if it can be shown as money. This means they care more about numbers than other kind of details. So certain things don't get written down and you won't see them on a company's financial papers. Some examples like how good the workers are at their jobs, like the skill of a worker, how nice or tough the job conditions are, how much money a patent could be sold for later on. So these are the terms that are not written in the financial papers, right? So let's see the applications of money measurement concept. Health of a proprietor or manager is not taken into the books, although it may have a great impact on the overall business, right? We do not include any inflation or deflation in the value of any asset. All accounting transactions are recorded in quantitative terms for easy comparison of performance between firms. So here it says that simply all the items that are measured in money or all the events that are evaluated in terms of money will be counted or written in the financial statements rather than the events which are not related to money, right? Next one is business entity concept. This concept separates the entity of the proprietor from the business transaction. The capital contributed by the owner is a liability for the business because business, which is an artificial person, is different from owner. Let's understand this simply first. There is a person called Ram. He opens a factory, that is a Ram's factory. So here this concept says that Ram is a different entity. Ram's factory is a different entity. Simple. So it declares that a business stands independently from its owner and hence the two should be treated as separate entities when recording transaction. Therefore, all business transactions like income, expenses, assets, liabilities, equity must be kept separate from the owner's account, that is from the Ram's account, to ensure accurate accounting records. So let's imagine an example. There is a toy store. The business entity concept means you should keep track of all the money you make and spend in your toy store separately from your personal money. So for example, if you buy toys to sell in your store, you would record that expense in your store's records, not in your personal money notebook, right? And if you earn money from selling toys, that money goes into the store's record, not your personal wallet. This helps you see how well your toy store is doing well without getting mixed up with your own finances. Applications of business entity concept are any money withdrawn by the proprietor is treated separately as drawings. That means if Ram take out the money from Ram's factory, that will be known as drawings account. Don't forget this. Okay. So profit. Next one is profit is a liability while loss is an asset. It means that a business stands apart from its owner. This is the reason why when an owner invests money, the business market marks it down as a liability on its record. That means when Ram put money in Ram's factory, that will be the liability for Ram's factory. Right? Similarly, the same principle applies when the business makes a profit. The business acknowledges its debt to the owners for that profit. Like if Ram factory earns some profit, so that will be counted. Financial outcomes are consistently formulated with the premise that the business and its owner are distinct entities. That's it for the business entity concept. I hope you understood this concept very well. Third one is financial performance of the entity is ascertained by recording the business revenues and expenses. Last one is useful at the time of liquidation for determining payouts to various stakeholders because they are the debts for the company, right? Next one is realization concept. This concept tells us when is the revenue treated as realized or earned. It is treated as realized or earned on the date when the property in the goods passes to the buyer and he becomes legally liable to pay for the goods. It means that a business can only count its money as earned when it has actually done the work or provided the things it got paid for. This means that the business can't count the money until it has finished its part of the deal. For example, there is a graphic design company that is hired to create a logo for a client. The client agrees to pay 5 lakhs for the logo. According to the realization principle, the graphic design company can't say it earned the 5 lakhs until it has actually finished designing the logo and delivered it to the client. Once the logo is completed and handed over to the client, the company can then recognize the 5 lakhs as revenue in its books. Right. So what are the application of realization concept? No future income is considered. Goods sold on approval will not be included in sales but taken at cost only. The rules of revenue recognition determine that the earning process should be either complete or near completion. That means when the product is completed or near completion, then only the revenue will be recognized that we have earned some profit, right? Next one is dual aspect concept. It says that every transaction has a double effect. One is debit and the other is credit. It is a rule in accounting that says every action you take with money has two sides. It's like a seesaw. When you do something with money, it affects two things at the same time. For example, when you buy something and pay with cash, you are giving money and getting an item. So the money goes down in your account and the item goes up in your records. It's like the two sides of the same coin. Similarly, if you are selling something and you receive cash, your money goes up and the item you sold goes down in your records. This happens together like a pair of actions that are linked. So this rule makes sure that all the money moves are accurately shown in your financial records. It's like making sure both sides of the seesaw are balanced and nothing is left out. So what are the applications? Every transaction has two aspects, right? And the accounting equation is asset is equal to capital plus liability. Clear? Historical records concept. Historical cost is a measure of value used in accounting in which the value of an asset on the balance sheet is recorded at its original cost when acquired by the company. So you have understood that in cost concept too, that the value of the item will be recorded at the cost at which it was purchased, right? So it is like a snapshot of how much something was worth when a business got it. It's like looking at the price tag from the past. For example, let's say a company buys a piece of machinery to use in its factory. At the time of purchase, the machinery cost rupees 10,000. But now it costs rupees 12,000. But according to the historical cost concept, the company will record the machinery in its book at its original cost of rupees 10,000, even if the machinery values go up or down over time, right? This way of recording things help keep the financial record simple and clear. It's like saying this is what we paid, when we got it, and we are going to remember that. Clear? Next one is going concern concept. This concept indicates that the business is a going concern. It simply means that the business will be termed as it will go on and on and on and on and on, right? It is like thinking of a company as a long-lasting ship sailing smoothly on the business sea. It assumes that the company will keep operating and making money into the future unless there is clear evidence it won't. For example, think of a cafe. If the cafe is doing well, has enough customers and is making a profit, it's considered a going concern. It's like the cafe ship sailing steadily, serving coffee and pastries. But if the cafe starts losing customers, can't pay its bill, and the owner decides to close it down, then it's not a going concern anymore. It's like the cafe ship hitting rough waters and having to stop sailing. So the going concern concept is about believing a business will keep going unless something really serious happens that forces it to stop. Right. So what are the applications of going concern concept? First one is fixed assets are valued at cost and not at market value. You have already read that. Depreciation is provided based on the total number of years of life of asset. Balances of 1 year are carried forward to the next year. Reserves and provisions are created for any future liability. Deferred revenue expenditure are written off over a number of years. What is deferred revenue expenditure? It is also known as deferred revenue expenses or deferred revenue items that are paid upfront but are gradually recognized as cost over a period of time rather than immediately in the period when the payment is made. That means simply it is a prepaid payment. Prepaid payment. Right? Like rent paid in advance. If a business paid rent for a whole year in advance, it would spread out the cost over the months of the lease period, right? So these are the expenses that are prepaid and their benefits are realized gradually over time, right? And the last one is it also helps investor as they can assume the life of the business entity to be infinite. Next one is matching concept. This concept explains that we have to match the income of a certain period with expenses of that period only. It means it is like making sure your expenses and your revenues are like puzzle pieces that fit together. It's about pairing up the cost of doing business with the money you make from those activities. Right? Here's how it works. Expenses means when you spend money on things like buying, supplying, paying salaries or other costs to run your business, you record those expenses. And the next one is revenues. When your business earns money from sales or providing services, you record those revenues. So the matching concept says that you should match up the expenses with the revenues they help generate. In other words, you should show the cost of creating the revenue in the same period when you earn that revenue. For example, let's say you have a bakery. You buy flour, sugar and other ingredients to make cakes. You also pay your baker's salaries. Then you sell those cakes and make money. The matching concept means you should show the cost of the ingredients and salaries in the same period as the revenue from selling the cakes. This way, your financial records give a clear picture of how much you are making and how much you are spending to make that money. So in simple terms, the matching concept helps keep your books accurate and shows how well your expenses and revenues match up over time. So what are the applications? All adjustments regarding prepaid expenses, outstanding expenses are made in the final accounts. Deferred revenue expenditure concept arises due to this concept. I have already explained you what is the deferred revenue expenditure. It is just a prepaid expenses, right? Next one is accounting period concept. It is assumed that the business will run for a long period, therefore accounts of each period are recorded. It means that it is a designated time frame where all the financial activities of a business are grouped together and examined. This period could be few weeks, a month, 3 months, a whole year, like January to December, or a fiscal year. This accounting period idea is important for investors. When people are thinking about investing in a company, they look at its financial reports like income statement, balance sheets. These reports show how well the company is doing during that specific accounting period. It's like watching a movie scene by scene to understand the whole story. So the accounting period helps everyone see how a business is performing at different point of time and how it's changing over those periods. So what are the applications? Comparing the financial statements for different periods. This could be fiscal year 1st April to 31st March or calendar year 1st January to 31st December. Uniform and consistent accounting treatment for finding out the profit and assets of the business. Matching periodic revenues with expenses for getting correct results of the business operations, thereby measuring the performance during the period in concern. Enables tax calculation and dividend distribution. Right? Next one is main conventions of accounting. First one is convention of full disclosure. It states that accounts must be honestly prepared and all material information must be disclosed therein. The Indian Companies Act makes ample provision for the disclosure of essential information in accounts. Law prescribes the content of the balance sheet and profit and loss accounts. What does that mean? The full disclosure principle says that all important information should be shared in the company's financial statements. This helps reader understand what's going on. However, it's not practical to include every tiny details. So companies focus on sharing things that really matter, like stuff that could seriously change how people see the company's money situation. Imagine you are buying a used car. The seller tells you all good things about the car, like its mileage and how well it runs. However, the full disclosure principle would require the seller to also tell you if the car was in an accident before, even if it has been fixed and now looks fine. This is important information that could impact your decision to buy the car, right? Even though the seller might not know all the details about that accident, they still have to share what they do now to give you a complete and accurate picture. Similarly, in financial statements, companies should disclose important events or uncertainties, even if all the details are not fully clear yet. Just like the car example, the goal is to provide potential investors or stakeholders with a transparent view of the company's financial health, including any significant matters that could influence their decisions. So the key is to provide enough important details so that people get a clear picture of what's happening without overwhelming them with unnecessary info. Next one is convention of full materiality. Convention of full materiality allows user to ignore or not focus on small or unimportant details in financial information. For example, some companies round off their financial numbers and leave out "we don't count paise" in our financial statement generally. So this is considered acceptable when dealing with larger figures like crores or lakhs, as these tiny amounts don't significantly affect the overall picture. So this is the convention of full materiality. What are the applications? The accountant does not record insignificant items separately. IND AS 1 allows that an entity need not present separately items of a dissimilar nature or function if they are immaterial. Whether an item is material or not depends on the size of the business of a company or entity. Next one is convention of conservatism. The convention of conservatism says that while recording transaction, all possible losses must be taken into consideration, while all anticipated profits should be ignored. Just remember that all the anticipated profits should be ignored, while all the possible losses must be taken into consideration. This is also called the principle of prudence. So the convention of conservatism is like a financial safety net. It encourages accountants and companies to be a bit more skeptical and careful while recording their finances when there is uncertainty about whether something is good or bad for the company's financial health. This principle suggests leaning towards the cautious side. It's a way to prevent overestimating profits or underestimating losses, making sure the financial statements are a bit more on the realistic and careful side. What are the applications of convention of conservatism? Creation of provision for doubtful debts, creation of contingency reserve, value the stock in hand at lower of the cost or market value, show the joint life policy at surrender value on the asset side of the balance sheet. Next one is convention of consistency. If a method is selected for recording and reporting purposes, it must be regularly followed in the future also. In simpler terms, this principle says that the importance of using the same accounting method, practices and procedure consistently over time is very significant. This means that once a company chooses a certain way to measure or record something, it should stick to that method unless there is a valid reason to change, right? So consistency helps ensure that the financial information is comparable and reliable from one period to another, making it easier for users to financial statement to understand and analyze the company's performance over time. So that's it for the concepts and conventions of accounting principles. This is it for this chapter. I hope you understood this chapter very well. If you have any doubts, then DM us on our Telegram channel. After this, go through the notes and complete the quizzes provided in the group in our Telegram channel. So see you tomorrow. Bye bye.